Appreciate everyone's time. So obviously, right, lunch and taxes usually equal sleeping. So post-lunch depression kicks in. But what I'm going to do today is just cover a couple topics at a very high level because, again, we're not looking to get into the weeds on this. So what we're going to do is I'm going to talk about four different areas of these are credits and incentives that are often overlooked by privately held businesses in the marketplace, as well as, and overlooked by their CPAs. So our firm, we are a tax consulting firm. One of the partners, we have about 25 employees, and our focus is specifically tax credits and tax incentives. So we partner up with privately held and publicly held businesses and their CPAs to maximize the benefits of these programs. The analogy that I like to use is your CPA is like a family doctor. You go to them, get your checkup, does your tax returns, but if you need a knee replacement, typically your CPA is not going to do it. You go to, your family doctor doesn't do it, you go to an orthopedic. We're kind of that orthopedic of the tax world. So the four credits that I want to talk about is R&D tax credit. We're going to talk cost segregation, which is more of a deduction versus a credit, but again, underutilized. We're going to touch base real quick on the export incentive and then talk about California Competes credit real quick. So as I mentioned, we do a lot more outside of just these four topics. We also do a lot of sales and use tax consulting, and unfortunately, I could spend a whole hour on the Wayfair case. It's a recent Supreme Court case that affects just about any privately held business that's selling into other states, but we just don't have time for that. But if you guys have heard about that or have questions, feel free to call me. Our client base goes from small pre-revenue biotech firms all the way up to some of the largest of the Fortune 1000 and everything in between. So let's talk R&D tax credit. So this credit is nothing new. It's been around since the 80s, but it's gone through tons of changes over and over again. So, and there's a lot of confusion about how it all works. But this is an income tax credit, okay? And there's both federal tax credits as well as there's state credits. Now, it's a very convoluted calculation of how you get to the dollar amount of the credit. A good rule of thumb is to just to use about 4.5% to 6.5% of your qualified expenses is going to be your credit. So think about that. So for every $100,000 that you spend on research and development, you're going to get anywhere from a $4,500 to $6,500 tax credit. And that credit is on top of the deduction. So you're not changing how you accounted for or your tax deduction. You're going to get a dollar for dollar reduction of your liability at the federal level. And then here in California, you're looking at, again, depending on how you calculate the credit, there's another 1 to 7% credit for California taxes. So when you're looking at that, it could be as high as 13, 14% between federal and state. Now, typically what happens, right, again, it's an income tax credit. So you're profitable, you're paying tax. That's one requirement in order to, to reduce your tax liability. If you have unused credits in any year, like for federal purposes, you can actually carry it back a year and go get refunds, or you can, and then any excess credits have a 20-year carry forward. In California, any excess credits you can't carry back, but you have an indefinite carry forward period. So, and there's value there that even if you have excess credits and you sell your company down the road, there's value there too to the buyer. There's some limitations on how they can utilize them, but again, there's value there. So it's always good to accumulate these credits depending on your utilization of them. Any questions so far? Yeah. No, it doesn't matter. So what happens, obviously, right, if you're a C corporation, the credits stay at the C corp level and you use it to offset the C corp tax. If you're a flow-through entity, S corporation, LLC, you calculate the credit at the entity level, and then it's going to flow through to the shareholders or the partners through the K-1s. So what qualifies for the R&D credit? So pretty much any company out there that's figuring out how do I make my products better, faster, lighter, and cheaper, those are all key indicators that you're going to qualify for the tax credit in some form or fashion. So, you're developing new or improved products, processes, formulas, algorithms, software, techniques, whatever the intellectual property is of the company. So again, developing new or improved. So this is at the company level, right? So you don't have to be doing something that's changing your industry. And that's a big misnomer. People, when they think of research and development, they think they have to be finding the cure for cancer. You don't have to be. You could be a manufacturer developing widgets. And chances are you're going to be able to qualify for the credit in some form or fashion. And R&D starts from concept, whiteboard sessions. You could be at home, taking notes on a napkin at the dinner table. And that could be the genesis of R&D. And then it goes all the way through until your commercial production. Once you've released the product, R&D is over at that point in time. But that R&D clock can start ticking again, because if you're going to take an existing product, this existing software, and you're going to change it to make it better, you're going to add functionality to it, then the R&D clock starts ticking again. What doesn't qualify? Obviously, the incentive is to do these activities here in the US. So if you're outsourcing outside of the country, something like that's not going to qualify. And this applies to hard sciences, right? This applies to engineering. It applies to computer science, bioscience. This doesn't apply to soft sciences, right? So it's not going to apply to marketing. It's not going to apply to social sciences, humanities. And then you got to look at, let's defense contractors, right? You got to look at, is it considered funded research or not? Who's bearing the economic risk of the R&D efforts? So just if you're a defense contractor, just because you're doing business with the government doesn't mean you can't qualify for the credit. Again, another big misnomer with defense contractors here in town. And it's the same thing with the biotech firms. You got to look at who's bearing the economic risk of the dollars being spent. And we talk through that later. So for any R&D activity to qualify, there's basically a 4-part test that has to be met. I'm not going to get into these because you'll just fall asleep. And I won't do that to you. But so it's again, you just got to go through the checklist and say, does my project meet these 4 criteria? And then there's, if you're developing a software that is just used to run your business, it's kind of back office, you're not selling it or you're not leasing it or a subscription model, and it's a true back office software, the IRS wants to create an additional higher threshold to qualify for that, so there's an additional 3-part test. So what goes into the credit calculation? There are 3 primary categories that goes into this calculation. This is primarily a wage-based credit. So you're going to look at your internal wages of your employees that are spending time on R&D efforts. Again, looking at what is your R&D process from concept to product release, and you're going to analyze everybody who touches that process. So you can have management. You can have direct employees, you got administrative folks that are touching that R&D process. And what you want to be able to do is analyze how they're spending their time and between qualified R&D activities and non-qualified, and you're going to include, their wages. Then you're going to get supply costs. So if you're building prototypes, right, and you buy materials and it goes into building a prototype, you're going to include the cost of those materials. And then if you outsource your R&D, let's say you hire third-party contractors, you can include 65% of what you paid third-party contractors. Now keep in mind, you accumulate these costs, you put it through the calculation, you're still getting a tax deduction for those costs, then you're going to get the credit on top of that deduction. A couple things with some new tax law. So historically, the R&D credit was a temporary part of the tax law, but in 2015, Congress made it a permanent part. So it's here to stay. So companies that are doing these activities, you need to take advantage of this. Like I mentioned before, it's an income tax credit. So you have to be making money and paying tax. However, starting in 2016 forward, if you're a true startup company, that means if you have under $5 million of revenue and less 5 years of revenue, you can make an election to take the income tax, this R&D income tax credit against your payroll taxes, the employer portion of payroll taxes. So this can be immediate cash benefit for a true startup company under the regulations. And then the other thing too is historically, okay, it's an income tax credit. As you know, there's two taxing systems, right? You got the regular tax system, and then you have the alternative minimum tax system. And the R&D credit typically was you could use it to take your regular tax liability down to AMT. Well, starting in 2016 forward, if you're under 50 million in revenue, you can use these credits against your AMT tax. That's big for a lot of businesses here in town. So that's R&D. I just did a big brain dump on you guys, and at the 50,000 foot level on the R&D credit. I mean, are there any questions on that?
Why don't you give us a quick example? But what's a case that you've done recently where you were able to bring this to bear?
Well, I mean, again, this applies to many industries. A case that comes to mind, and just a recent one, is an apparel manufacturer. So the company's, obviously here in San Diego. They do all of the design work of their products here in the U.S. Obviously, it's apparel, so the manufacturing's not done here. So the manufacturing is overseas, and then they bring the product here and they distribute out. But their design team and their development team, their R&D team is here in the U.S. And they have probably 10 people that are responsible on a day-to-day basis for developing and creating new product. And we did a look-back study, all open tax years, so you can actually look back 3 years for federal purposes, 4 year for state. We generated an $833,000 tax credit for them that they weren't taking, and that's real cash.
Folks, remember, this is not a tax deduction. This is the tax credit. It means it comes off dollar for dollar. Yeah. That's what makes it so awesome.
Yep. And again, if you are taking advantage of it, it's always good to have a second set of eyes because you may not be maximizing the benefits. We've noticed that a lot where we've come in and taken over the credit calculation that was being done by somebody else, and we noticed that a lot of times we double the credit. So let's talk cost segregation real quick. Anybody hear cost segregation before? I mean, it's pretty standard. It's been around for a while.
Everybody's in real estate.
Yeah.
Apartment buildings especially.
Exactly.
So pay attention on this.
So cost segregation is nothing more than a depreciation study. Okay. So if you buy a piece of commercial real estate, or if you buy commercial residential rental property, the tax law says commercial real estate you got to depreciate it 39 years, straight line. Or 27 and a half if it's commercial residential, rental property. By doing cost segregation, what you're going to be able to do is you're going to get your money back faster. You're going to recoup your investment faster because you're going to look at the building and you're going to break it apart, and everything that's non-structural, you're going to accelerate into 5, 7, and 15 year versus 39 years. So you're going to get your tax deduction a lot quicker by doing cost segregation. Now, keep in mind, if you're flipping properties, right, you're buying and you're going to sell it in 2 years, 3 years, you don't want to do this. Unless, it still works with 1031 exchanges, but typically if you're flipping properties and you're not doing 1031, you don't want to do this because the tax law makes you recapture the depreciation above straight line. So again, if you're buying and holding for a long term, this makes so much sense. So that's the concept. And typically you're looking at, you can get anywhere up to, depending on the type of building, 20, 30% of the building accelerated into quicker life. But with the new tax law, this is where it gets really interesting for cost segregation. So bonus depreciation has gone from 50% to 100%. So any property basically put into service in 2018 forward, you're going to get 100% bonus depreciation on anything that you accelerate into 5, 7, and 15 year. So think about that. You buy a $5 million building. Let's say you accelerate 20% of that. It's $1 million. You're going to write off $1 million in 1 year, in the very first year. I mean, that's big. And this applies to used property. Before, bonus depreciation was only for brand new, but that tax law, that changed as part of this law change as well. The downside, well, not downside, this part of the tax law is not as good as it used to be. So you buy a piece of property and then you make improvements to it. So it's under the tax law, it's called qualified improvement property. historically, that was all 15-year depreciable property. Then you can cost seg it and get into 5 and 7 year. There was a technical error in the current tax law, and so for any qualified improvements, so you could be the owner, right, and you do the improvements, or if you buy the property and you're leasing it, the tenant does their own improvements. All of this property now is 39-year property. So because it's just the way that it was an oversight when they wrote the law. There's talk about they're trying to get it fixed, but who knows? As you know, Congress is so dysfunctional. The likelihood of them fixing it anytime soon is slim to none. But you could still accelerate some of that 39-year property into 5 and 7 years. Where it gets really interesting is, you guys are familiar with the concept of 179 expensing, right? So you buy equipment, right? And basically that 179, being able to expense that all in 1 year under Section 179, that's gone up to $1 million. So that's a big increase over the old tax law. But here's where it gets really interesting. There's part of your building that if you bought, the roofs, the HV, the exterior windows, that's all still considered 39-year property, but now it's eligible for 179 expensing. So even though you're accelerating all the other stuff into 5, 7, 15, writing it all off under bonus depreciation, you have part of your building that's still 39-year that you're going to be able to write off under 179. So again, you're just added value for purchasing real estate. So I got 5 minutes left. I'm going to touch base real quick on federal export tax incentive. This is a tax incentive for if you're exporting, I would say probably $2 million and above. So you need to have property that is produced, grown, extracted here in the U.S., and you're exporting it outside of the U.S. This incentive is underutilized all the time, and the incentive is if you're a flow-through entity, S corporation, partnership, LLC, and you're exporting product outside the U.S., what the government's going to do is they're going to give you preferred tax treatment on your export net income. So instead of paying ordinary income rates, say 37% under the current tax law, you're going to get qualified dividend treatment on your export net income. I mean, think about that. It's 20% plus 3.8, the Obamacare tax, 23.8%. So you're going to reduce your tax rate by 13.2% on your export net income. I mean, that's pretty big. And if you're a C corporation, right, and you're exporting, what you're going, typically, if you're paying dividends to investors, dividends are not tax deductible. But if you run that dividend through the DISC, you generated a 21% tax deduction for dividends. I'm not going to get into that. One last topic is California competes. Anybody hear about this one? Okay, this is California's first entree into a negotiated tax incentive. So in essence, this replaced the old enterprise zone. So this came into law in 2014. So what they do is the state has about $200 million, which is peanuts for the state, that they're going to hand out to incentivize companies to grow and expand in California. So what they do is they take this $200 million, they break it down into 3 different application periods, and you have to apply for it. But to apply for it, what you have to do is you have to project out your growth and investment in California over the next 5 years. So you're going to look at, okay, how much incremental wages am I going to pay over the next 5 years? Because I'm growing and expanding, am I buying real estate or leasing real estate? You're going to look at that. Are you buying or leasing equipment? You pull that number in, so you aggregate this number, and then you're going to ask for tax credits based off of that number. And it's a convoluted process, but if you have the right facts and circumstances, you can actually leverage this into a pretty meaningful tax credit. And again, this is a California credit only, so it goes against your California income tax. So what happens is they gather all of the applications. So you're competing against everybody who submits an application. So you're competing against all the other companies. And then what they're going to do is, let's say if they're awarding $75 million, they're going to take 150 million of applications and move that into phase 2. And in phase 2, that's when they're going to start looking at the application and figuring out, okay, what kind of jobs, what industry were you located, and then they're just going to keep cutting applications out until they get to the award. So that's kind of how it works. But if you're a small business under $2 million, what they do in the law, they don't get enough applications for small business. So if you're under $2 million and you're growing, there's a high probability that you can get an award under this. We had a small ship repair company that we got them a $100,000 credit under this program for 5 jobs. So it can be meaningful. I'm not going to get into all these other slides, but I think my time is up. All right, any questions on the California Competes?
Talk about a little bit what we're doing with smart meters and also how that applies to cities or schools or other kind of clever things.
Sure. So as I mentioned before, we do a lot with sales and use taxes and indirect taxes when you're looking at what people are buying. And so California has this really obscure sales and use tax exemption called a technology transfer agreement. So, and again, this can apply to any company that's buying, making significant purchases of assets that have a lot of embedded technology as part of the piece of equipment. And this applies to schools. I mean, this applies to cities because no one's exempt from paying this tax. But this exemption allows you to, and this is based off a couple case laws that I'm not going to get into, but basically what it does, it allows you to look at that piece of equipment and bifurcate out the tangible hardware of the equipment versus the intangible software that runs that piece of equipment. And you should not have to pay sales tax on the intangible software. So think about the city of San Diego is spending tons of money on smart parking meters, smart lighting, all the onboard computers that are in the police cars and things. I mean, it's millions and millions and millions of dollars each year. And the ability is there for them to bifurcate out the value of the software, not pay tax on that, or get refunds back on the past 3 years of purchases. I mean, that's one thing. Yeah,
Okay.
thank you.
Thanks,
Appreciate everyone's time.